2008, the global economy nearly collapsed. Trillions of dollars vanished, banks crumbled, and millions of ordinary people lost their homes. But what if I told you that years before it all unraveled, one man quietly saw it coming, and not only that, he bet against the entire system and made nearly $800 million in the process. This is the story of how a quiet, eccentric investor read the fine print no one else cared to read, uncovered the dangerous truth behind Wall Street's biggest bubble, and made one of the greatest trades in financial history. But this isn't just history, it's a lesson in how incentives, greed, and blind optimism can bring down entire economies. To understand how he did it, we need to rewind back to the early 2000s, back to the world of mortgages, Wall Street, and one very dangerous assumption that house prices could only ever go up. Let's start simple. Imagine you want to buy a house. You go to the bank, they lend you the money, and you slowly pay it back over 15 or 30 years. That's a mortgage. Nothing complicated. But what happens when thousands, no, millions of people all take out mortgages at the same time? That's where Wall Street steps in. Big investment banks realized that they could buy these mortgages from local banks, bundle them together, and sell slices of that bundle to investors. These slices were called mortgage-backed securities. If you owned one, you'd get a little piece of everyone's monthly mortgage payments, like owning shares in America as housing market. Investors loved it. Pension funds, insurance companies, even governments bought them. Why? Because people always pay their mortgages, right? And house prices always go up. Right? But here's the catch, not every homeowner could actually afford their mortgage, and not every mortgage was created equal. Some were solid, some were risky. To deal with that, banks created a system of tranches. The safest mortgages went into the top layer, the senior tranche. Riskier loans went into the mezzanine, and the riskiest of all went into the equity tranche. If homeowners defaulted, the equity tranche would take the first hit, then mezzanine, then finally the senior layer. On paper, it looked brilliant, safe at the top, risky at the bottom, and something for everyone. But in reality, it was a house of cards, and while investors thought they were holding safe, diversified assets, in truth, they were exposed to millions of shaky loans that were about to go bad. And this is exactly where our investor enters the picture. Enter Michael Burry, a former Dr. Tund, a hedge fund manager with a knack for numbers and a habit of reading the fine print no one else bothered with. While most of Wall Street relied on ratings agencies and surface-level reports, Burry went straight to the raw data, the mortgage prospectuses, thousands of pages of details about who was borrowing money, what kind of loans they had, and when those loans would reset. And what he saw was alarming. Banks weren't just lending to responsible families anymore. They were lending to anyone who asked. People with no income, no savings, even no job. These weren't traditional 30-year fixed mortgages either. Money were what is called adjustable rate mortgage or ARMs. They started cheap with a low teaser rate, but after a couple of years, the interest would reset much higher, meaning millions of borrowers were signing up for loans they'd never be able to afford once the teaser ended. And it got worse. Banks rolled out interest-only mortgages. For a few years, borrowers didn't even have to pay down the loan, just the interest. Some loans were even negative amortization, where your debt actually grew over time because unpaid interest got added to the balance. To Burry, it was obvious. These loans were time bombs. They only worked if housing prices kept, and Burry knew something else too. Most of these risky loans were set to reset in 2007. That meant millions of homeowners would suddenly see their mortgage payments skyrocket at the exact same time. He did the math. He studied the time, and he realized the housing market wasn't just overheated. It was a ticking bomb. And the countdown had already begun. Now here's the big question. If you know the housing market is going to collapse, how do you profit from it? Michael Burry found the answer in a little-known financial tool called a credit default swap. Think of it like insurance. Normally, you'd buy insurance to protect your house in case it burns down. A credit default swap is insurance for investments, except here is the twist Dante. Even need to own the thing you're reinsuring. Burry approached big banks like Goldman Sachs and Deutsche Bank with a wild request. He wanted to buy credit default swaps on the riskiest slices of mortgage-backed securities. In plain English, he was betting that these mortgage bundles would eventually collapse. And here's how it worked. Burry would pay the bank a small fee every year, like an insurance premium. If the mortgages stayed solid, he'd lose money. But if they failed, the bank would owe him massive payouts. At first, the banks were thrilled. They thought he was crazy. To them, housing prices never went down. selling him insurance on something they thought was rock solid. Was easy money? But Burry wasn't crazy. He was early. Between 2005 and 2006, he quietly built positions, totaling billions of dollars in bets against the housing market. His hedge fund clients were confused, even angry. Why pay millions in premiums for something that hadn't happened? But Burry stuck to the numbers. And then, right on schedule, the bomb started to go off. In 2007, the teaser rates on millions of adjustable-rate mortgages expired. Overnight, families saw their monthly payments double or even triple. And just like Burry predicted, many couldn't keep up. Defaults started small, then snowballed. Across the country, people were walking away from homes they could no longer afford. Foreclosures piled up, and the housing market, the one everyone thought was unshakable, began to crumble. As house prices fell, refinancing became impossible. The lifeline homeowners depended on taking out new loans on rising property values was gone. And when homeowners defaulted, the mortgage-backed securities tied to those loans collapsed in value. Even the supposedly safe AAA-rated tranches began to bleed losses. Panic rippled through Wall Street. And while most of Wall Street was in shock, Michael Burry's bet began to pay off big time. The credit default swaps he bought skyrocketed in value. As banks scrambled to buy insurance of their own, the contracts Burry already held were suddenly worth hundreds of millions of dollars. But it wasn't smooth sailing. His own investors had doubted him for years, angry at the losses from paying premiums. Now, they were sitting on massive gains, but instead of celebrating, many were furious that he had locked up their money during the trade. Burry later recalled that even investors who made tens of millions weren't entirely grateful. The emotional ride had been that brutal. And of course, the crisis spread far beyond Burry's fund. Major banks collapsed. Lehman Brothers went bankrupt. Global markets seized up. Millions of jobs vanished. What started as risky mortgages in suburban America turned into the worst financial crisis since the Great Depression. When the dust settled, Michael Burry's trade went down as one of the most legendary in financial history. Personally, he made about $100 million. His investors, despite all the drama, walked away with more than $700 million in profit. From 2000 to 2008, his hedge fund returned nearly 490%, while the S&P 500 barely moved. One man, reading through thousands of pages of mortgage documents, had beaten the entire system. But beyond the money, the lessons were far bigger. The 2008 crisis proved how dangerous unchecked incentives can be. Banks made loans they knew were bad because they could sell them. Rating agencies stamped risky securities with AAA labels because they were paid to. Investors ignored the details because everyone believed housing prices could only go up. And in the middle of all that noise, only a handful of people stopped, looked at the numbers, and asked the obvious question. What if everyone is wrong? Michael Burry showed the power of independent thinking. He wasn't guided by emotions, headlines, or herd mentality. He trusted data, even when it made him unpopular. And when the world caught up, he was already prepared. The crash devastated millions of families, and its effects are still felt today. But if there's one takeaway, it's this. Blind faith in rising markets is dangerous, and sometimes the biggest opportunities come not from following the crowd, but from questioning it. And that's the story of how one man predicted the 2008 housing crash and made $800 million in the process. If you found this breakdown helpful, make sure to hit the like button, subscribe, and share this video with someone who wants to understand finance without the jargon. Thanks for watching, and I'll see you in the next one.